I interviewed Professor Jeremy Siegel of the Wharton School yesterday in overtime. You know what? His view matches up with some of the more sunny outlooks for the remainder of this year, in large part because of what he thinks the Fed is going to do and, frankly, what it isn't. Here's Jeremy Siegel.
I think they should do another 100 basis points by the end of the year. You know, I mean, the market expects a bit more, but that does fulfill a good tightening. I don't think they need to go higher than that. And, you know, scaring the market saying we're going to stay high through 2023 when they have no idea what's going to be happening in 2023, I think it was really not a good image to project.
All right, so that's Professor Jeremy Siegel. So, Farmer Jim, I mean, he largely is in your camp. And I said to him, OK, so if that is the result, if you're right and it's 100 basis points more and that's it, what does that mean for stocks? And he said something to the effect of overwhelmingly good. Now, yes, the flip side of that is what UBS is talking about today, even as they maintain their own view of 100 basis points for the remainder of the year. Further volatility caused by earnings revisions, downgrades, and higher than expected default rates over the course of next year. That's a very plausible view for both outcomes. What does that mean then for stocks?
What I think is, and I'm going to try to riff off of what Josh said, because I think he said it very elegantly and very balanced. There are many potential scenarios going forward. OK, and anyone who says, slamming the table, that this is the scenario that is going to happen. Hang on.
But we need to deal in probabilities. That's what all of you do with the way that you invest and the way that you design your own market outlooks. The higher probability right now is that I could see, OK, Fed goes 100 more, 50, 25, and 25, a high probability of that. There's also a high probability that earnings revisions are going to happen, and they're going to come down. It's only to the degree that they do. I think that is a high probability on both.
OK. So
I think one can agree with that.
Well, no.
Where?
No. So, but just
where? Just tell me where.
OK. All right.
Just tell me where.
Just don't start yelling at me, OK? When I disagree with you, you tend to yell, and I don't like it.
Just tell me where. I'm not yelling at anybody.
It matters your perspective, OK? What I do is I talk to company managements. I listen to earnings calls.
Okay.
I go out and do my own gumshoe detective work. And what I'm telling you, just simply, is that aggregate demand, all right, has not fallen off the cliff, that everybody who says earnings are ready to just calamitously fall.
I didn't say calamitously fall. I said there are going to be downward revisions. Let me phrase it almost a formality at this point. You suggest that earnings are not going to be revised lower at all.
Well, they might be revised lower. No, we're talking about probabilities. I don't think there's any need for derision as we disagree, Scott, okay? I don't think it is a fait accompli that the earnings are coming down. And again, based on my perspective, I note, by the way, and just give me a little rope on this, okay? I note that 3 months ago, we were having this discussion, and there was a concept of the analysts are out of their minds. They're delusional. It's a word that's been used a lot over the last.
I used that word many times in describing why they hadn't taken down their estimates to that point.
And maybe you're right. Hang on one second, Jenny. Maybe you are right. I'm dancing with you on this. You may well be right. I see the probabilities as not quite as high as you do. And this is coming from the perspective of listening to company managers. It doesn't matter whether it's Cisco Systems, Wynn Resorts, Hewlett-Packard Enterprises. You know, this is my perspective. Other people have different perspectives. I don't see the rapid drop in earnings that I think the bear case is predicated on.
Can I bridge this?
Go ahead.
Okay. So I think the rapid drop in earnings is really the key. And as usual, we're talking about magnitude. Scott, when we were arguing about this same thing maybe a month and a half, 2 months ago, we were talking about $230, $200 earnings for the S&P for this year. And what you and Josh were pushing back on me on was exactly what Josh is bringing up now, that we need to look at Forex, we need to look at the price of the dollar, we need to look at interest rates. But and you guys were saying if foreign exchange, if the dollar stays strong, that technology companies are going to get slaughtered. It's going to plummet S&P earnings. It's going to be terrible. And when I was saying, OK, but 16 times earnings, 18 times 230, you kept saying, but the earnings are what's in question. And as it turned out, this past quarter, earnings held up kind of surprisingly well. And they held up surprisingly well because, as it turns out, a lot of the major contributors to the S&P 500 earnings are not the big tech companies. They're the companies that are doing really well, like Chevron and Exxon and United Health. So I think earnings will come down. Right now, we're at $250 about on 2023 earnings.
Right. That's way too high.
I agree. But let's say they're 240. Let's say they come in at 240. You know what the multiple is right now on $240 earnings? It's 16.5 times. That gives you a reasonable amount of wiggle room. And you know what? All those stats that I cited before, PMI, consumer confidence, gasoline prices coming down, this is going to buoy companies up to some degree. The market, the economy is not as bad as it feels, and it's not as bad as it looks.